hostel in Iceland has become a bit of a tourist attraction after putting the country's last McDonald's meal on display. Their original wrapping from 2009. Amazingly, 6 years on, the burger is still not mouldy.
The story of Iceland during the great financial crisis of 2008 is a unique case study for the world. Iceland's decision to let banks fail and refuse creditor payments stands in stark contrast to the too big to fail policies seen elsewhere. It also highlights the importance of comprehensive reforms, economic, political, and judicial, necessary to achieve lasting stability. For Iceland, the lessons of the past remain as crucial as ever, etched into its volcanic landscape and perhaps preserved in a McDonald's burger that refuses to decay. Iceland welcomed McDonald's in 1993 with great fanfare. The Prime Minister at the time, David Oddsson, famously took the first bite. But in October 2009, amidst the fallout from the 2008 global financial crisis, McDonald's abruptly shut down all of its operations in Iceland. Rising costs for imported ingredients made running the franchise unsustainable. Also in 2009, Hjörtur Smárason walked into a McDonald's in Iceland, purchased a burger and fries, and made history. This wasn't any ordinary meal. It was the last McDonald's meal sold in Iceland. Hjörtur didn't eat the burger. Instead, he kept it, curious about the claims that McDonald's food could seemingly defy time. A decade later, that same burger and fries remains eerily pristine, displayed in a guest house in South Iceland. The financial crisis that forced McDonald's out of Iceland was unlike anything the country had seen. In the early 2000s, Iceland's economy boomed, driven by aggressive expansion of its three largest banks, Glitnir, Kaupthing, and Landsbanki. By 2007, these banks had ballooned to hold assets 9 times the size of Iceland's GDP, with international operations attracting a flood of global capital. The government's deregulation and botched privatization of the banking sector had set the stage for what came next. When Lehman Brothers collapsed in the United States in September 2008, it triggered a chain reaction. Iceland's banks, deeply over-leveraged and under-regulated, were too big to save. Within weeks, all three fell like dominoes. The national currency, known as the krona, lost half its value, inflation skyrocketed, and Iceland faced economic devastation. In desperation, the government turned to the International Monetary Fund and neighboring countries for a $4.6 billion bailout. But this was only the beginning of Iceland's dramatic recovery story. Unlike many other countries, Iceland refused to protect its international creditors. This controversial decision left creditors unpaid to the tune of 4 times the country's GDP, effectively clearing Iceland's slate to rebuild its economy. It also allowed the krona's devaluation to boost Iceland's critical tourism center. With its breathtaking landscapes suddenly more affordable, Iceland became a magnet for visitors, attracting over 2.2 million tourists annually by 2017, 7 times its population. But the road to recovery wasn't just economic. Iceland's handling of the banking crisis also carried significant political and judicial dimensions. Investigators revealed rampant corruption within the banks, including illegal market manipulation and fraudulent loans. 39 bankers were sentenced to prison, totaling nearly 100 man-years. Yet, some critics argue that these sentences targeted minor players while sparing the most influential culprits. Jared Bibler, a former investigator at Iceland's Financial Supervisory Authority, uncovered staggering levels of fraud during his tenure, but felt his work only scratched the surface. His book, Iceland's Secret: The Untold Story of the World's Biggest Con, details how deeply corruption had infiltrated Icelandic society. Meanwhile, the political fallout was seismic. Public anger erupted into protests, with citizens banging pots and pans in the streets. The revelations of the Panama Papers in 2016 further fueled discontent, exposing links between Icelandic politicians and offshore tax havens. Despite drafting a new constitution to address these systematic issues, political inertia stalled its adoption, leaving many Icelanders frustrated by the lack of meaningful reform. Today, Iceland's economy has largely rebounded. GDP has grown from $12.9 billion in 2009 to over $20 billion. Employment is at record highs, and the tech industry is gaining momentum as a potential new economic driver. Yet, the recovery remains uneven. Critics warn that political and judicial reforms have lagged behind economic process, leaving vulnerabilities unaddressed.